if you do your research into investment, you probably heard a lot of people saying about the S&P 500, the Dow Jones, the Nasdaq Composite, and the SP500 have a 7% rate of return, annual rate of return, right? And they kind of right, but it's not a very good habit to actually look at the data and see the fact for yourself instead of just listening to other people. And so that's why I'm doing this analysis right here. Right? Here you have the three most popular index analysis, and the three most one you have S&P 500, you have the Dow Jones, and you have the Nasdaq Composite. And just to make sure this is a fact, you can always look it up, and you can see this is the S&P 500. You have the Dow Jones mainly for industrial, and you have the Nasdaq Composite, right? The three most popular one, and then there are plenty more. I just prefer the popular one. And here, what we can do is we can look up the SP500 historical rate of return, and there's a lot of different number here, anyways. But I'm looking for data and not just the conclusion, though. If you look at data here, this is a good data. I can take all the data, copy it. Then once you copy all the data, you can go back to the Google Sheet. I'm gonna name it S&P 500, and then right click, and you can go for the paste special, right? You got the values only, and you're gonna get this chart right here, right? You have the year, and you have the rate of return. The rate of return in this column, annual percent rate. Just not be over here. Let's see, this one's gonna be all the way over here. So this one is the year, and then seems to be over here. Closing high, average closing. Okay. Okay, so average shift a little bit to this way. And then year here. Okay. That makes more sense. Okay. Now you have the data for S&P 500. You make another one for Dow Jones. And again, just do exactly the same thing. You're looking for the data, not the stated facts right here, right? You want to confirm that fact and double check that. Again, you have this similar website. Copy everything, copy, go to over here, right click, paste special. You want to choose the values only. Then here you have to shift everything a little bit to the right. And percent change, right? Percent change. Yeah, that seems about right. Open high, low, close. Open high, low, close. Okay. Seems about right. Okay. Next is the Nasdaq Composite. Pretty much the same thing. Do you like this website though? That seems a good one. Here you go. That does seem a good website to put in, not gonna lie. Got a lot of number and data here. And they're more likely to be correct when you have numbers, right? Because you can always double check with other website. There's special, values only. Then change this a little bit to the right. And then this annual percent change. Yep. Yeah. Now we have all the data. Now we can actually do the analysis and double check what they say is correct or not. And for S&P 500, just you want to quick double check. You know, you always say them on YouTube or something. They always say it's about 7%. So I'm going to confirm that. This is average, by the way. Average of the percentage. You got 7.86. So that's about right, right? Now you know why they're saying it that way. Maybe try this. It's more than that, so that's going to be 3. It was 8% for the Dow Jones. Copy that to the Nasdaq. You get about 12% average rate of return for the Nasdaq Composite. So you can double check some of the facts they tell you. Can I make another one? This is the actual analysis, I will say. Yes, in this analysis, I want to make a roughly graph kind of. And all of this information, I'm mostly interested in the annual percent change because I can calculate my money based on the percent change, right? And the other one is not so important. If I invest over a course of 40 years, then these numbers are pretty irrelevant. And these three ETF or not ETF, the index, they are very popular and well known too, so I don't have to worry about some fishy number in the open and close in the year. With that in mind, I want a year, and then the other one's going to be percent change. This is annual percent change, by the way. Okay, to that. Then we're gonna have 3 of them, right? For this one, we're gonna have the SP500, you have the Dow Jones, and you have the Nasdaq. Can merge this one. Okay, for year, let's see. We have a lot of them, not gonna lie. They're not in the order I like, I would say, so let me try to flip them. Oh, so let's try to flip them. There should be a way to do it. Out of them, data sort, column G. Data. What about this? Okay, that works. I mean, you can double check this, not gonna lie. S&P 500 historical return is 23 is 24 is 13. Oh, this is Dow Jones, never mind. Dow Jones. The first one, 13. This is 2023. Okay, so this is correct. And then the last one is 81%. 81%. Okay, so that's how you do it. I'm just going to repeat for all of them. Data Z percent. Okay. And the Nasdaq can have the data data Z. Okay. Now we have all of them. Let's see. The earliest we have is going to be the Dow Jones, start at 1915. The next year is going to be the previous year plus one. One. And we keep continuing to have the year. And the earliest one going to be 2023. That's the current year. So that's a lot of year. Almost there. 2013. 2003. Okay. That's good. For S&P 500, I'm going to start from 1928 to today. 1928 right here to today. Okay. For Dow Jones, you start all the way from top, 2023. And for the Nasdaq, that's the earliest one, what I remember. They still have a very good data for analysis, so I start from 1972. 1972. Yeah, that's pretty early. 1972 right here. Okay, good. Now that we have all the data, all the year, and all the rate of return taken from the website, which is hopefully helpful and true, and can double check the facts. Now we can do something about it. We can do a graph kind of to see which one going to be the best one, or we're gonna also do like a roughly Roth IRA compound interest calculation to see if with this actual rate of return are we gonna be get $1 million after 40 years. And if you look at the let's see, current Roth IRA limit, no more than $6,000. Okay, so $6,000 per year, right? Next, oh, 6,500. I think they raised it this year, I believe. 6,500 a year. So let's say this H, you can start at 18, and this is yearly contribution, and then you have current money. So let's say 18 is each year plus one, and then you can take out 60, I believe. 60, okay. The yearly contribution, I mean 18 you in college, so let's say you can put $50 per month times 12, 600 per year. Then you'd have to do that for 4 years. 1, 2, 3, 4. And then after that, you can contribute to the maximum, right? Hopefully. So with that, that's gonna be to the rest of your life. I know if you're those under 50 and 8,000, no, after 50 years old, that's a different number. 7,000 if you're 50 or older. Okay, this is 123, 6,500, and 7,500 if you're older. Yeah, so after 50, it's gonna be 7,500. This is the yearly contribution. And the current money, okay, this is where the you know beauty of compound interest come in, right? I mean, you also have three of them. Let's get a different, you have different interests, so different money, right? So if you look at S&P 500, let's see. After the first year, it's going to be the same money, obviously. So that's pretty straightforward for the first year. But the second year, oops, what am I doing? Let me zoom it up. The second year is going to be the first year times the interest, well, not just the interest, but 100% plus let's see, end of the second year gonna be the return of the second year. So that's the last year plus the percent change of interest, and you plus the current contribution. Okay, this one is S&P 500. Okay, that is not what I want. Let me freeze this actually. View, freeze, two rows. Okay. So this is not D17 on S&P 500, so that's going to be B17. Okay. And this is all money, by the way. And repeat that. Right, you take the last year, return the 100% that plus the interest of that year. You add the contribution. Okay, that's about right. You add all that up. Yep, so that's for the S&P 500. See if this is true for the other year. If the previous year one plus the is for the Dow Jones, okay, that's about right. And then plus okay, okay, this is not the right one. It has to be G. It's going to be the yearly contribution. Then copy down of that. And finally, for the Nasdaq, again, just copy and paste and double check with the previous year 1 plus D70, that's right. H, that's not in G, so I'm using distribution. You're gonna repeat that. Last year 1 plus interest rate, and then this is the yearly contribution. Okay, that's good. Copy it to the rest. Yep. And so here you're 60 years old, and let's say you live 30 years more. What that means is you're going to take this number divided by 12 over 30 years divided by 12. That's going to be the monthly money you get to the rest of your life, kind of, if you keep using them. in the worst case scenario too, because they're gonna grow in stock anyways. These are the three number to look at, and if you just look at them, I mean, you can tell the S&P 500. This is the standard market. It's pretty much this market. It'll be 1,700,000, which is high, a little bit higher than the Dow Jones, because they are famous for blue chip companies, right? They big and boring. They just not increasing a lot, but also very safe. You don't decrease a lot. And then finally, you have the Nasdaq, which is almost like double. It's like almost $3 million, but at the same time, you know, high return come with high risk. So um, it's it's definitely worth it in the long term. If you're in the market for 40 years, then probably go with this, but it's also risky, you know. That's the thing. And also this when I finish with this a fun thing you can do is it's also really depend on the year you're in the market. Like you just copy this, delete this, and I paste it in other time in history. Right? So let me pin this black so I know what I'm doing. So let's say I put it right here. And this number is a little random too, but I guess. So you put it here, then I can end up with, you know, you can see the number here. Yeah. Then this one in this case, the Dow Jones performed better than the S&P 500, and the Nasdaq doesn't perform that much better than the Dow Jones, right? So it really depends on the time you enter the market and how it end up, because it can be somewhat random. And like there's some year you get more money and some year you don't get less money. So you can play around and see roughly what you're gonna get. But I can tell like 2 millions and 3 millions over here seem to be a safe assumption. And of course there's inflation and everything else to take into account too. So the 5,000 here may not be that much, and the Roth IRA limit contribution can also increase over time, right? But unless you have the number and you calculate it yourself and don't have to believe in someone else's statement about the annual rate of return of some random index. Another thing I like to do is create a graph. That's probably more helpful to do graph compared to this. Let's see. If we want to do graph, I think we need a column that's going to be more helpful, money column to keep track of what we're doing. Actually, three more columns. Each of them track each of the index. Okay, so insert column. How do I come to the right? Don't have that. Oopsie. Hope this don't get messed up. Oh, okay, they don't get messed up. That's good. Okay, that's good. They don't get messed up. To the left, to the left. Okay. And again, I'm gonna have this three. This one is not annual rate of return. This one's gonna be money. Right? I want a common unit to make a graph. Okay. So let's say, where do we have all of them? Right? The next one is pretty late. Well, not late, but compared to the other two, it doesn't have like there's some history over here. Or maybe I just don't know how to find it. Anyways, but S&P 500. Let's start with, I don't know, the number doesn't really matter, 1,000 maybe. And these are all money, so the money type. Let's start with 1,000, all of them. So we can start from here. Then the next year, we're gonna take this previous money times 1, which is 100% of that money, well, cannot lose the value anyway, so plus what the percentage over here, the annual return, you get a different money, right? So $1,000 after 1 year of 15.63%, you're gonna increase it this number, make totally makes sense. Keep doing that. So we just put the money in the market and don't do anything to it. This is what's gonna happen. And I'm using that just to um, like compare the three different index. And also you can have some meaningful from the graph, so like tell you something about the market too. Right? Just here. Good. Now I have the money data. So if I put $1,000, then I'm gonna get this amount of money. And also again, you can see the market is about this, about correct, right? Yeah. The market is this 46, and then the Dow Jones is a little bit below the market, is 42. The Nasdaq, which is above the market, or even double, you have the 116,000. Let's see, how do you create graph in here? Data, but there's just the rough numbers. There's just a rough number. But it's always good to have more data, create a graph, so make sure you see the right patterns. Let's graph it somewhere in here. Chart. You can have different kind of plot. This one is the one of the popular one when I learned in high school. All of them. X-axis. The graph right here. And this is gonna put the year in. That's gonna start. Yes. Wow. X-axis. This. Gonna start from 1971 until today. And then the y-axis, I'm gonna add in the S&P 500 money. Oops, where is it gone? Add series, click this. I'm adding all the S&P 500. And so that's the S&P 500 one. We have this graph of S&P 500 money after a certain year. Title is going to be index analysis. Horizontal, we have the year, and then vertical axis is money. And then this color is going to be, well, I need to add another color, I think. Let's see. Can add the Dow Jones. Yeah, now I'm going to have another color. So the blue one's going to be S&P 500. The red one is going to be the Dow Jones. And then finally you have the Nasdaq. And another series. So the yellow one is going to be Nasdaq Composite. Yeah, so this is our graph. Again, fit some of the data in. Line maybe. Color series. Maybe not. Polynomial. 10. 10. Not 8. 6. Yeah, something like that. Um, you can roughly see the trend. But yeah, like the Dow Jones is going to be the lowest. SP500 in the middle. This one over here. It's not so obvious in this kind of graph though. So see what else I can do. I know the other type of graph can be helpful. Like the columns generally make a lot of sense. You can play around a little bit. Not gonna lie. Oh yeah, this one looks. Oh, this one has S&P 500. Oh no, not stock. But a stock column that's different. Pipe. That's funny. I don't know. Diagram maybe. Column. This one seemed about right for me. This is my opinion. Yeah. Move it to my. If you just look at the like most of the trend, you can see like if the um Nasdaq went the yellow one. This has the highest one throughout history, right? And then next you have the generally the blue one, which is the S&P 500, although that's a year that the the red one, the Dow Jones beat it. But most of the time, the order is the Nasdaq Composite, and then the S&P 500, and then you have the Dow Jones. And again, they does not necessarily mean it's good or bad. It's just the data. And high risk means high return. So you can see high return, but also means it's high risk. If you can demonstrate that high risk, you can plot the instead of plotting the money, if you want to see the risk, is you can plot the percentage and you can see the risk. Pretty damn clear. So again, you go ahead. This one's going to be this way. Insert chart. Move, move. X-axis going to be again. That's going to be the same year. And the y-axis, I'm going to put in the percentage instead. That's the S&P 500. It's going to be the Dow Jones. And then, so this is going to be SP500. The red one is going to be the Dow Jones. And the last one, looking for the Nasdaq Composite. Okay. So this one would be Nasdaq Composite. Let's move this. Oh sheet. Okay, here you can see the both, um, you know, the percentage increase, and this is the annual change here. So if you can see, although the Nasdaq have a higher, when the year is up, it's higher than the other one, but also when the year is down, when you have a loss, the Nasdaq also have higher loss compared to the other two. And it's a general trend, I could say. But there's some exception here and there too. But in general, like if you win, Nasdaq's gonna be big, and if you lose a lot too. And also you can see another the trend of the stock market. If you look at a few years, you're gonna have up and down, but you look at the whole trend of history is generally up, and the up case more than the down case. And that's also helpful to know if you stay in here. long enough, you will make some progress. Doesn't guarantee it, but oh, the data say so. And here, same, if you look at other market, I think the S&P 500 is pretty standard. You can just look at it and know that's the market, that's the standard, and you compare the other two. The Nasdaq's a lot more risky. It's a lot more risk, but also a lot more return. The Dow Jones, on the other hand, it is less risky, I believe. Okay, this is an exception. But in most of the case, when the Dow is not Dow as S&P 500 this year, this year, this year, this year too. But when it's up, also low risk, low return, it's not as high. Right. In many cases, not as high as the S&P 500. And then also, so yeah, that's good data to know, and keep it to yourself and know what you're doing. So from this kind of data, what I end up thinking, and it's an opinion, not a fact, that if you're going for long term, so if you're going long term, you can take the risk. You're long enough, you have time, and you can take the risk. And probably go for Nasdaq Composite. And as simple as 1Q, by the way. Get that Nasdaq Composite. Oh, pretty sure it's 1Q. Yeah. Wait, where's 1Q though? Nasdaq Composite Index. Oh, okay. Interesting. Oh, wait, yeah, I was looking at the percentage. Oh, interesting. I thought 1Q was Nasdaq. Oh, it is Nasdaq Composite Index. I don't know, it was a little off from here. That's pretty interesting for me. But anyways, you can always look them up, I guess. And then the SP500 is VOO. SP500 index, and you have the VOO. I hope that's not the same. No? Okay, I guess. Okay, this graph. Okay, never mind. I was a little outdated on that. But anyways, yeah, so if you have more time in the market, go for Nasdaq. Um, if you close your retirement and you don't want to risk it, maybe Dow Jones or even safer, bond or something like that. And if you have like mid-ish, I'd say Nasdaq is like 40 years in the market. That's pretty safe. SP500 show me is like 20 years-ish. Um, then probably S&P 500 is less risky, but also less return. And then it is very close, like 10 years, 5 years, and maybe something safer. You don't want to put everything in Nasdaq, in your 60, and all of a sudden you have a crash and you're done, right? So that's pretty dangerous. Well, that's an opinion, up to you though. Can't control that. Yep, thank you for listening to the analysis.